Welcome to Chapter 6. Here we're going to continue to talk about the audit opinion formulation process and a framework for obtaining evidence. The focus on this chapter will be about obtaining audit evidence. Excuse me. So what is audit evidence? Well, here we have a definition by Auditing Standard 15. It's information that's used by the auditor in arriving at conclusions on which auditors' opinions are based. There's two main points that we need to consider when we talk about audit evidence. We're talking about the appropriateness and the sufficiency. Okay, so this exhibit shows the interrelationships of risk and evidence, appropriateness, and sufficiency. So we talked a little bit about risk the last couple of chapters, the difference between inherent risk and control risk, and that's going to determine how much, which is the quantity of evidence that we need to collect, or the sufficiency. And then we need to look at the appropriateness of that sufficiency, with the two main threads being relevance and reliability. And this is the quality of the evidence that we collect. So basically we're looking at quantity and quality of the evidence. So here these terms are defined. Relevance. We touched on this before. Basically, the evidence that you're collecting needs to be able to provide insight on the validity of the assertion that you're testing. So if you're looking at the completeness assertion, obtaining evidence about the value of the account is not going to be relevant to supporting the completeness assertion. So you need to make sure that the audit evidence that you're looking at is relevant. And then you need to look at the reliability of that evidence. So whether the evidence is convincing, and one of the things that we look at is where it's coming from or how it was obtained. So the purpose of an audit procedure. We've talked about on the different types of audit procedures that we're performing. So there's three main types. We're looking at a risk assessment, we're testing controls, or we're performing a substantive procedures. Okay? The risk assessment happens at the beginning of the audit, and we're identifying the risks of material misstatements. So typically this is in the form of a walkthrough or a flow chart of the process. Test of controls is evaluating the effectiveness of the controls in detecting and correcting material misstatements. And then finally, we perform substantive procedures, which provides direct evidence about presence of material misstatements. So we'll touch on these a little bit more. One of the things that's important to look at for relevance is not only the assertion that you're testing, but also the direction of the testing. Okay? So one of the things that we look at when we're testing an account balance is we need to consider the type of misstatement that's likely to occur. So for assets and revenues, we're basically testing for overstatement of those. We're less concerned if they're understated. Obviously, it's a misstatement is still a misstatement. But when we're looking at assets and revenues, we're testing to make sure it's not overstated, that they're not reporting more than they actually have. And for liabilities and expenses, we're testing to make sure that they're not understated or have less than they say they do. And this is where we look at the difference between vouching and tracing. Vouching and tracing are two different types of audit testing or audit procedures. So testing for existence is vouching. You're basically starting with the subsidiary ledger or the general ledger, and you're tying it back to the source document. Okay? So you're making sure that the number that is in the financial statements actually exists. So this is typically used when you're testing assets or revenues. You want to make sure that the revenue that the client is reporting actually exists, and you're going to go back to the source document, which is the invoice or the bill, any proof that they sold the product. Panel B is testing for completeness. So here you're looking for, this is when you're testing for expenses or liabilities and testing for understatement. So here you're starting with the source document and you're tracing it to the subledger or general ledger to make sure that's included in there. Okay, so this test, tracing is used for mainly expenses and liabilities, and vouching is used mainly for revenue and asset accounts. So there's direct and indirect evidence. Direct evidence is relevant to the specific assertion, and it requires only one inference to reach a conclusion. So that means that you don't need to connect the dots, okay? It's pretty obvious that it's supporting that account. Indirect evidence is not directly related to that specific assertion, and it requires you to connect some dots to provide assurance. When we're looking at the reliability of audit evidence, we're going to look at its ability to provide convincing evidence related to the audit objective being evaluated. So you can see what ISA 500 or A31 says about reliability of audit evidence. You need to look at its source and its nature and the circumstances under which it's obtained. So remember in the audit book, Pat obtained the bank statements directly from the bank and it was sent directly to his office. That makes the information more reliable, as opposed to if he had gotten it directly from the client, then it wouldn't have been as reliable because the client, as you saw, actually doctored those statements and took the check out and replaced it with a false check. So that's what we mean when we talk about the reliability of the evidence. There's two different types of documentation. There's internal and external. Internal evidence is always considered less reliable. This doesn't mean that it isn't reliable. It's just less reliable than if you were obtaining external evidence. Internal evidence comes from inside the company that you're auditing, and the reliability depends on the internal control effectiveness. So if they have effective internal controls, it becomes more reliable. If they have ineffective controls, then it's less reliable. It depends on management motivation, the formality of the documentation, and the independence of the documentation preparers. So, I always love to say it depends. Well, these are the points that it depends on. So whether you can rely on it depends how reliable the sources are. For external documentation, it's always considered more reliable, but it also depends on whether it was prepared by a knowledgeable and independent outside party and whether or not it was received directly by the auditor. So the example that I just talked about with the bank statements. You'll see that in audits, sometimes you'll get management specialists. So these are third parties that assist management with certain processes for their financial statement reporting. An example is a fair value specialist looking at impairment, or an actuarial looking at the pension expenses. And the reliability of the data and the relevance depends on the individual or organization and making sure that they possess expertise in the field other than accounting or evidence. So you need to consider the following factors: the competence, capability, and objectivity, the work performed, and appropriateness of his or her work as audit evidence for the relevant assertion. So one of the things that we need to do as auditors when we're using a management specialist work papers is that we need to actually audit those work papers and audit the specialist and make sure that they're knowledgeable and they have the expertise to be providing and preparing that work for management. So there's a lot of different types of audit procedures. There's actually 9 specific different types of audit procedures: inspection of documentation, inspection of assets, observation, external confirmations, recalculation, reperformance, analytical procedures, scanning, and inquiry. Some of these are used mostly during test of controls, and some of them are used mostly during substantive audit procedures, and some are used in both scenarios. You can refer to Exhibit 6.7 in the book for management assertions and examples of the related audit procedures that you would use to test those assertions. The exhibit shows you what you could do for fixed assets and contingencies. So, excuse me, I'm going to go back to this slide for a second. One of the things that when you're performing audit procedures is that you need to assess the consistency of the evidence. So you need to make sure that the information is consistent. You need to consider the internal consistency of the evidence gathered, the consistency of the internal evidence generated with external evidence gathered, and expand evidence gathering procedures for areas where the results are inconsistent. So that means that you expect to see some things. If something doesn't work the way it's expected, then you need to investigate further. The timing of when you perform these audit procedures is also important. So we've touched on this before. You can either perform them at the balance sheet date, at an interim date, which is earlier than the balance sheet date, and after the balance sheet date. And the decisions really are based on the internal control assessment, how effective the internal controls are, the nature of the account, and the availability of audit staff. So one of the procedures that we almost always perform at the balance sheet date is the inspection of assets. So we do an inventory count. If you have a client that has inventory, you perform an inventory count with the client on the balance sheet date. So if the year end is 12/31, then you go to the audit and perform an inventory count on 12/31. And I've had to do that several times for some of my clients when I was working at EY. Okay. Depending on the timing of the procedures, there's certain additional procedures that you need to perform. So this is referred to as a roll forward period. If you're performing interim date procedures, then you need to roll forward from that interim date to the balance sheet date. So if you're performing procedures as of 9/30 and it's a 12/31 year end, you need to roll forward what happened in those last 3 months of the year because you've only tested through 9/30. The cutoff period covers several days before and after the client's balance sheet date. So what this looks at is recording transactions in the wrong period, and it's applied to transactions recording during the cutoff period. This is mostly done for making sure that they record liabilities and making sure that sales are recorded in the right period. So they need to provide evidence as to whether the transactions have been recorded in the proper period so that they've captured all liabilities and that they haven't overstated their revenues. So here's a timeline of what the timing of the procedures looks like. So you have the period being audited, so this is the year, the fiscal year. This is after the fiscal year, this is the balance sheet date, and the cutoff procedures are usually 5 to 7 days before and after. So some of the things that we need to consider in performing substantive analytical procedures. Exhibit 6.9 in the book shows us a chart of alternative approaches to substantive procedures. And actually, I'm going to go through that exhibit in class so we can talk about it a little bit more. But basically, when you're looking at performing substantive procedures, you need to ask yourselves these questions. And the main question is, do they have adequate internal controls over the account? Are they operating effectively? And is the risk of material misstatement low enough that inferences from indirect evidence are appropriate to make conclusions about the account? We need to check the relevance and reliability of the data, and then understand the relationships. So when we're performing analytical procedures, we need to determine whether or not it's suitable to do so, evaluate the data reliability, develop an expectation. Okay, this is where a lot of people get tripped up, in the part where you have to develop your expectation. What that means is when you're looking at a specific account, you expect things to happen, and it's not going to be the same every time. So for example, if you know that the client's industry has experienced a downturn in the current year, then you would expect their revenues and their sales to be lower than the prior year. So your expectation may be revenues have decreased within 5% of the prior year. So if you're comparing year over year, you need to determine the amount of acceptable difference. So if it's more or less than 5%, you need to say how much is acceptable to you. So 5% of that, 10%, 0%, you have to develop your expectation and the amount that's tolerable. Then you need to compare the expectation with client's recorded amount, investigate any significant unexpected differences, and then document your findings. So the precision or expectation, which requires the auditor to use disaggregated data, is part of determining the effectiveness of substantive analytical procedures. So desegregation means that you're breaking down the data into their component parts based on time periods, geographical locations, customer type, or product lines. So when you're doing analytical procedures, you may look at their top 5 largest customers, or you may look at what's going on in the Northeast region separately from what's going on in the Southeast region, because those are 2 different markets. So you really need to understand your client's business in order to appropriately develop analytical procedures that are going to give you reliable and relevant information. There's different types of analytical procedures. I'm not going to read through these. You can read through these. I think they're pretty much self-explanatory, and we can talk about more of them in class if you have specific questions on them. Okay. So we've been talking about the quality of the data. Now we're going to shift gears to the quantity of that data. So the quantity of the audit evidence is affected by your assessment of risk of the material misstatement, the quality of the audit evidence, and assurance obtained from other procedures. So if you have low risk, you need less evidence. If you have higher risk, you need more evidence. If the quality of the data is not reliable or it's not as relevant, then you're going to need to find more evidence. The amount of evidence needs to be sufficient to convince the audit team of the effectiveness of the internal control or the accuracy of an account, and it needs to stand on its own so that another unbiased professional would reach the same conclusion. So this is really important because I think we've talked about before that audit firms get peer reviews. So that means that other audit firms or the PCAOB comes in and reviews documentation of the audit client. So if they're looking at documentation and the audit evidence isn't sufficient enough that that person can reach the same conclusion on their own, then it's not sufficient. Okay. So one of the things that we're looking at is sample sizes when we do our audit procedures. So there's different sample size considerations when you're looking at test of controls versus substantive audit procedures. So for test of controls, you need to look at the control being tested, the frequency which is performed. So if you're looking at control that happens every single day, your population size is going to be bigger than if you look at a control that's performed once a month. Controls over adjusting entries require additional consideration due to high risk of material misstatement, and typically the better the control environment, the smaller the sample size. So one of the things that you'll be auditing if you go into audit is management estimates. Management estimate typically refers to management judgments, so such as bonus compensation. That's the easiest one that comes to mind. They don't know the actual amount that's going to be paid out until the books are closed. So they're making an estimate about their incentive compensation for the year. The judgments need to be established by independent, objective, and verifiable data that supports the estimates, and the auditor needs to understand the process used by management in developing estimates. So any controls that exist over the process, reliability of the underlying data, use of outside experts, and reviewing procedures for results of estimates for reasonableness. So incentive compensation, pension entries, stock options or restricted stock, anything like that, fair value and impairment analysis. So these are all judgment and based in management estimates. So in addition to that, as part of those estimates, you may have a specialist or expert obtaining or assisting with obtaining the evidence. So again, you need to make sure that you have tested and evaluated the specialist qualifications and the work that they performed, and ultimately the responsibility for the audit opinion lies with the auditor. So you need to make sure that you have obtained enough evidence that you agree with the specialist's work. You need to evaluate their qualifications, so their professional certification, license, or anything else that is recognition of their competence. Look at their reputation and standings in the field, and their experience in the type of work under consideration. So one of the most important things that you look at is related party adjustments. So what this means is a transaction with other organizations or people that are related to either the client or client senior management. If they do have related party transactions, it results in a higher risk of material misstatement of financial statements. The transaction might be conducted under normal market terms and conditions. It may not be conducted, so there might be some special bias or special terms. So the auditor needs to identify all related party transactions and account for those transactions and make sure they're properly disclosed in the financial statements. So one of the ways that you do that is looking through board minutes, looking at legal letters from the lawyers of the firms, and just looking through transactions for related parties, which you can do using specialized audit software as well. So now that we've talked about gathering the audit evidence, let's shift gears to talk about documenting that audit evidence. So you guys have heard me say before, if it's not documented, it's not done. Documentation of the evidence that you obtain forms the basis for the auditor's representations and conclusions. It helps in planning, performing, and supervising the audit. It forms the basis for reviewing work quality, and it includes the records of planning and performance of the work, the procedures performed, the evidence obtained, and how those conclusions were reached. Okay? So you need to have an audit trail. You need to document how you planned your audit, why you chose the procedures that you performed, which is based on your risk assessments. Then document the actual procedures that you performed, include documentation of the evidence that you obtained, and the evidence needs to be able to support the conclusions that you reach, and it needs to be able to do so that an independent party can reach the same conclusions. The audit documentation needs to be prepared in detail, so it needs to be clear, it needs to have a purpose, a source, the conclusions reached. So you'll see that on almost every single work paper, there's going to be a conclusion on there. And if it's not a work paper where tests are actually being performed, then it'll say what the purpose of that work paper is and what conclusion it's supporting. And you need to appropriately organize the work papers to provide a clear link to the significant findings or issues. So here's what you need to document, which I just spoke to. So what are the characteristics of quality work paper documentation? And I'll go through this in class as well. But basically, every work paper needs to have a heading, which includes the name of the audit, an explanatory title, and the balance sheet date. You need to have initials or electronic signatures of the auditor and the date the test was completed, and then the person that reviewed the documentation and the date that the review was completed. The work paper page number, and a description of the test performed. I know this seems pretty anal, but it's really important to have this information so that you can follow the flow of the information and support the conclusions that are being reached. It's kind of actually one of the reasons why I like audit, is because it's very organized, it's easy to follow, and you can just follow the flow through all the work papers. You need to have tick marks and a tick mark legend indicating the nature and the work performed by the auditor, assessment of whether the tests indicate possibility of material misstatement in the account, include cross-references to related documentation, a section identifying all significant issues that arose during the audit and how they were resolved, and then the auditor's conclusion. So I'm actually going to go through Exhibit 613 in class so we can talk through what a work paper actually looks like. Ultimately, the procedures that you're performing during an audit are dictated by the audit program. And the audit program is developed as part of the planning phase. So these are where you document the procedures to be formed in gathering the audit evidence. It records successful completion of each audit step, and it provides an effective means to organize and distribute the audit work, monitor the audit process and progress, and then record the audit work performed and for the managers, partners to review the audit procedures. When I worked at EY, we actually had an electronic audit program, So everything was performed electronically. The audit program was in a internally developed software system, and it linked all of the assertions, audit tests, and everything. So it was really easy to follow and really easy to make the links between the audit evidence and the tests that you're performing and why you were performing them. So that wraps up chapter 6. I know I went through it kind of quickly. I'm going to touch on a couple of key points in class on Tuesday, and then just make sure that you read through the cases for Tuesday's class, which I don't have at my fingertips right now, but I will post the cases in the announcement that I sent out. Thank you for your patience as I'm recovering from the stomach bug. Very much appreciated.